Hello, welcome everybody to Learn with Stanley webinar number 24. Welcome everybody, and today you can see that my background is a little bit different. I'm actually on travel, but welcome everybody, and so grateful that you're gonna spend the next hour with me, hopefully, and I have prepared quite a lot of things to discuss with you guys. Merry Christmas before we begin. And today we're going to talk about something quite special and a little bit more personal, I guess, looking into my own portfolio and how I'm thinking about protecting it for the year to come. And let's me share up the screen. Let me know if you guys can hear me well. And also, why don't you share a little bit about your experience of investing in 2024 this year? What has been your best performing stock so far? How has your portfolio done? Let me know down in the comment section. Right. And let's talk about 2024 review and looking forward to 2025. What should we be thinking about? How should we be looking in positioning our portfolio for the year to come? As always, this is just for information purposes only, and I myself is now a wealth advisor with iFAST Global Market. And do note that whatever I'm presenting here today is purely my own personal view and not the position of iFAST in any matters. And do take this as just for education purpose and do your own research before making any investment decision or talk to your financial advisor. And of course, you guys know that I'm now a wealth advisor with iFAST Global Market, and basically we are a wealth platform that allows you to access almost every asset class around the world that you need for your diversified portfolio. We have access to brokerage of investing in the stock market through the US, China, Hong Kong, Malaysia, and Singapore market. And on top of that, as we are a wealth advisor, we also provide access to many of the unit trusts in Malaysia, including direct bonds through our bond supermarket. Okay, and something that I try to focus a little bit more on is with my clients is really finding out the key philosophy of investing for each of them, and creating a portfolio that is specifically unique to them, that allows them to scale over time. And for myself, that has been always looking at the longer term, focusing on very high quality companies, and not trying to time the market so much, and being comfortable being a contrarian in the market, whether of investing against the market or having a different view with the market. And what I'm trying to do is always to create a portfolio that is scalable in my view. So even when I'm having a smaller portfolio size to when I'm grow the portfolio to a much larger size, I want my strategy to being consistent, and it allows me to scale it up over time. And right now, for all of my clients, I'm also sharing with them my journey of building what I call my ETF plus portfolio. This is a sub portfolio that I'm running on trying to showcase to them that we might not even need to be stock pickers at all. And just building a portfolio through ETF alone, we could still achieve pretty good result in the long term. And all this is based on my own investing strategy, which I'm going to talk a little bit more about later on, and which is something that I've been tracking since 2007. So what are we going to focus on today is going to be taking a quick look at what has happened in 2024. What are some of the key winners and losers in the market? Hopefully, you can share your experience as well through this time. Like I said, click up the chat box and let me know how has 2024 been for your portfolio, and what are you thinking about in the years to come, or what are some of the questions that you might have for me. Just put it down on your chat box, and we'll try to get back to that later on at the Q&A section. And then later on, after talking about a review of 2024, I'm going to talk about a little bit about how my investing strategy and portfolio evolved over time, over the past 17, 18 years, and trying to, I guess, answer the question of key questions of all investor is when you're looking back, is it truly skill or luck that brings your portfolio to where it is today? And how should we prepare ourselves for the years to come? Okay, so 2024 winner and losers. Drum roll. This is a slide from our iFast team, and you can see that the most of the major markets are being tracked here, and it has been a stellar year for most market. I would say that it's if you're an investor here, and if you have been invested in 2024, it most likely going to be a good year for all of you guys. So congratulations to you. You can see that today, this year, the stellar market is still the Nasdaq market, which has shot up more than 30%. But closing near closing having similar return is the Taiwan market, the US broad market, and surprisingly, the China H shares market has also been doing pretty well this year. Um, and a lot of it, of course, coming from the end of last few months, and quite an exciting time to invest in China as well. The entire global MSCI World Index has also risen about 19%. So, no, even as a diversified market as the World Index is still a pretty high performing market this year. So going down to our local markets like Singapore, Malaysia, it will all pretty much in the double digit return this year. So very, very exciting year for most of us. And one of the most impressive return come from the asset class of cryptocurrency. Just Bitcoin alone this year ran up close to 150%. And of course, that with the new election of President-elect Donald Trump coming onto the office, that has given a boost, giving how he has indicated that he might want cryptocurrency as a reserve currency for the US as well. So that's pretty wild idea. And even for the bond markets, this is the US aggregate bond index. Even for the bond market, typically is quite jaded, quite muted. This year, we are also seeing positive return in the bond market as well. So this is basically the chart of the S&P 500, and one of the most talk about ETF that follows the S&P 500 ETF, which is the US index, is the Vanguard S&P 500 ETF. So imagine you have bought at the beginning of the year, maybe you sell it here, buy it here, sell it here, buy it here, right? Just this year alone, you could make like 50% of your money. But of course, joke aside, market timing is really not what we're going to go after. And I think, generally speaking, we do not want to play that game because that is something that is highly unsustainable, in my view. If you're looking to create wealth for the long term, trying to always time the market would most likely be detrimental to your portfolio in the long run instead of creating positive return for you. So just a quick look back on my own portfolio. This is something I pulled up yesterday as well on my statement. And my own portfolio is mostly invested in US companies, but I do have some exposure to both the Hong Kong market and also a little bit on the Singapore market as well. Very, very small for the Singapore market, and maybe about 10-15% of my portfolio is in the Hong Kong market. And so far this year, my portfolio has increased roughly 40%, which is pretty amazing. And if we track the portfolio return that I've been tracking since 2007, this year marks a new high for my portfolio, coming off from the COVID high. And then in 2022, we saw a drop, quite a sharp drop after the COVID pandemic, and it was recovering. And I would say this is another new high for my portfolio this year. So what I wanted to share a little bit on the backstory here is how my investing philosophy has really changed over time for the past 17 years, Uh, and although you're seeing this chart of relatively good growth portfolio, there are quite a number of down years that I experienced as well. You can see that almost every 3 or 4 years I experience a down year. And what I wanted to highlight is also uh, of how my investment philosophy actually changed over these few periods. And I wanted to conclude later on uh, what has changed over the last 17 years, but what are the things that has stayed true throughout this entire time. And I believe that thing that I didn't change is key to seeing that my portfolio could really grow in the long term. So right at the beginning in 2026, I would say that was when I have just entered the workforce, about a year into entering the workforce. And I got very, uh, I guess I got sucked into the value investing philosophy. And I devour every books that I can find about Ben Graham, about Warren Buffett, on anything that I can find on fundamental investing and value investing. And value investing is most famous for buying things that are very cheap, that are considered undervalued. And is a good term is what Ben Graham has coined, or Warren Buffett has coined, called the cigar butt investing. So these are companies that are not pleasant, but it's like picking up a free cigar butt that's still lit on the ground. It's soggy, it's half lit, and doesn't look good, and looks quite dirty, but there's still a few good puff left, and you get to enjoy that few puff uh, for a very, very cheap price. So that is what deep value investing is all about. And at the beginning, how I search for companies is that I will look through newspaper at the time that I'm mostly still searching through newspaper. And every day I look through the 52-week low list. So on the newspaper, they will show a table on stocks that has broken 52-week high and also 52-week low. So those that are trading at their lowest point in the last 52 weeks from a year ago. And that will be my hunting ground. And I found, companies, a lot of companies are in the oil and gas sector, um, and they have very, very low PE. Some of them have very, very high debt, are highly, highly levered. But I found some that could deem as possible value stocks. And these are the companies that I started buying. Uh, and what I found is I have mixed results. Sometimes I'll buy companies that truly are undervalued and they get realized from the market, and the market realize that these are undervalued companies, and the price will shoot up and I'm able to sell them for a profit. But there's also a lot of times I caught into what we call a value trap. So I buy into this company thinking that they are cheap, but many times they are cheap for a reason. And a key lessons I learned here is that cheap rubbish is still rubbish. So what happens is there's a lot of companies that I buy into, and they could turn out to be fraudulent company, which is why it looks very cheap on the paper, or they're just very poorly managed companies. And for example, the shareholder might be not being fair to minority investors and is holding a lot of cash and not returning this cash to shareholders. So the value can never cascade to minority investor like ourselves. And these stocks will continuously stay cheap for a long, long time. After that, After this period, I realized that it's not very sustainable because if I'm lucky, I meet a few stocks that I make money, I straight away need to work harder to find other stocks that I can do it again. Because once the money is back in cash, I need to find something else to invest. And if not, I'll be stuck with companies that are doing poorly and has no way of uh, giving me a profit. And so it's kind of like a lose-lose proposition for me. And after the financial crisis of '08, '09, I started to realize that that is something that I want to move forward from. I wanted to change. And 2009 to 2014 is what I call my crazy experimental era. I was trying anything that I learned. I was learning a lot, just through online, listening to different strategy. At this point, I tried try going into playing a little bit of options, things like options, and something in particular called leaps, right? LEAP, and leaps are basically options, long-term options on companies. So options you can see it as you're buying a chance to participate in a company uh, in the future. So if I buy uh, a call option on a company, meaning that I'm buying the opportunity to purchase a stock of the company in the future, right? So this is a very basic form, basic explanation of option, and leaps is basically a long-term option. So most option is time at like 30 days, 60 days, 90 days. But leaps can be termed in terms of number of years. So I can buy the opportunity to buy a company, say 2 years later. And what this does is it gives me a lot of leverage. So, for example, if I say I want to buy a leap on, say, Apple, and Apple today, just for this simple illustration, say Apple is trading at $100 today, and I can buy this leap to buy Apple in 2 years' time, say for $120. But this leap will only cost me, say, $1 or $2 to buy it. So if today Apple really shot up from $100 to $130, my my leap, which is my option to buy Apple stocks, would probably jump from $1 to $10 or $20. So instead, if I buy the stock at 100 and it goes to 130, I earn 30%. But if it moved from $1 to $20, I could 20%, 20 times my money. So all these are in theory, it could happen. But in practice, of course, there are other factors to think about. There are a lot of costs involved in playing options. And the short story is, for me, I feel it didn't work. For number one, there's a lot of things to consider, and most of the time, the options are pretty well priced. So uh, it doesn't really give you a lot of benefits, and it gives you a lot more work, and you have to continuously monitor and know when your option is going to expire. If you don't constantly look at it, it could go to zero at any point. So that's my experience with crazy experience with different style of investing, different style of asset classes. And but I will say that by 2013, 2014, I more or less has found my own style. And I'm leaning more and more towards the style of Charlie Munger, which is the partner of Warren Buffett. And he basically is very focused on buying high quality companies. He's the one that advised Buffett to move away from being a cigar butt investor, from being a deep value investor. Buffett has always been buying companies at a very cheap price. He doesn't really care so much about the quality of the business as long as he can buy it at a cheap price. And Munger is really the person that elevated his game to ask him to focus more on high quality and good growing business, because this company can has will have the ability to continuously grow their size and their business over the long term. And that means that instead of, say, for example, in the beginning, if I'm a deep value investor, after I make profit from one company, I always have to move to find a next company. It means that I constantly have to work harder and harder to find replacement company to invest in, because the old company that I invested in, they are of poor quality. Most likely, I cannot keep them for long term. Whereas Charlie Munger promotes the idea that if you buy a great company, you only do the work once, because the company will continue to grow for a long, long time as long as they have their economic moat intact. And this really elevated Buffett's game and built what Berkshire Hathaway, their holding company, to what it is today, which is one of the only non-tech company within the top 10 in S&P 500 today. So that's when during 2013-14 is when I really fall into in place on my investing strategy, and I focus a lot on buying up all the high quality companies. And this would be, of course, your Magnificent Seven, your Apple, your Google. These are the periods where I started investing into them. For example, I invested in Meta Platform, which is Facebook at the time. And that was right when Facebook was facing the issue of Cambridge Analytica, which is a big scandal that happened in Facebook, where it is found that a third party was using data from Facebook to manipulate and help a politician manipulate election. And it blew up into a big scandal, and investors lost confidence in Facebook. Government is trying to crack down on Facebook, and just basically it is a very, very unloved company. I would say this is a perfect example of a high quality company, but at a time where you can buy it at a very good price. And that was more or less around the time where I started investing in Facebook, and I basically just kept it even until today. And through the ups and downs, of course, it went up, and then during the COVID pandemic, it crashes down again. But now this year, it is happened to be a great year for them again. So as long as the quality of business remains high, I don't mind continuously holding this company because I have the confidence that this company will grow over time. And that's what Charlie Munger really taught me into focusing on the quality of the business rather than the stock price. But I would say that even though the core part of my investing strategy is formed during that period, my mental strength in investing has not been fully formed. Of course, I went through the '08 financial crisis right at the beginning of when I started to learn about investing. But I have always had this problem of not truly able to grasp when the market is high or is forming into a bubble. Emotionally, I'm not able to, number one, detect it, and also I'm not really able to stop myself of joining the frenzy. So during COVID time, if you guys remember, of course, everybody is locked into the house, and there's really nothing much to do except a boom in the stock market. And so everybody got excited of investing. And it is a clear sign of a financial bubble where, because of quantitative easing, where there's a lot of money being poured into the stock market, a lot of free money that the government is pouring into the stock market as well, and people with a lot of time in hand just trading the market. So when we look back today, it looks like a classic case of a financial bubble. But in the midst of it, I myself is also being caught up in it, and I got overly excited. I got overly excited to the point where I adjusted my strategy a little bit. So previously, I was only focusing on companies that has a proven track record of high quality, good balance sheet, so very safe, big cap companies that has been growing for a long time. But during this period, when things are going so well, I started to create a smaller portfolio of investing in more riskier, fast growing companies. These will be, if you look back, these will be companies like your Zoom, which was unprofitable at the time. Company like com companies like what DocuSign. There's one called Fiverr where you can basically use the website to find freelancers to work for you, and all these less than famous tech companies, I started investing into them as well. Of course, we all know the end of this chapter of the story, which is I got very badly burned on that part of the portfolio. Most of the company dropped, around 80% uh, after the COVID crash. Um, and more or less, I have bought them close to the peak. Um, and that really taught me a big part on just trying to maintain my emotions a little bit, regardless of how the market is reacting. And that's why for this year, when the market is doing so well, what I try to do this year consciously is to resist of trying to become too smart in the stock market and just focusing on investing as per usual, which leads me to more or less what I'm been practicing in the last 1 or 2 years, which is focus on more investing passively, of creating a core identity and philosophy of my portfolio, of what I like in the long term, what are the companies that I like, what are the ETF that I like, and just focusing on this narrow uh, list of potential investment that I'm going to focus on. And a big part of them is using ETF. Now, sometimes I might not be able to find specific companies that I want to buy, and I would just invest in the broad market through ETF and just dollar cost average over time. And that would most likely be how I'm going to be investing over the long term now, and of understanding that uh, how we want to balance out our time and also chasing return. Because out of the past 16, 17 years, what I realized is, yes, I can do a lot of work in trying to find the best company and the best opportunity out there. Sometimes I would be able to outperform the market, but sometimes I might not. And more or less, it balances out throughout the long term, and I might edge out the market, say 1, 2, 3%. And is that 1 or 2 or 3%? Although it can balloon to a huge sum, but at this stage of my life, is it really going to be worth the time? Especially now with kids, that I have kids, I have to make that balance, because when I was still single or just newly married, without kids, I have all the time in the world. I don't mind spending a lot of time on the research, on understanding investing, and researching on companies, and being very particular on the when I buy and when I sell, and monitoring my portfolio constantly. But now, with four growing kids, and and uh, trying to build my business as well with iFast, I feel that time is more valuable than chasing that extra 1 or 2% of investment gain. And I want to make sure that I have a portfolio that is still going to do decent well and is still going to track the market at least, but I'll gain up and I'm going to free up a lot of my time to focus on the things that I want to, which is number one, serving my family and also serving my clients as well. Right. So when we look back, especially in my case, when I look back, and I hope you do this exercise as well. If you have been investing for some time, be it for the past few years, for the past decade, for the past 2 decades, take a look back and think of proportioning out maybe how many percent of your portfolio return is based on luck, and how much do you feel it's based on skill, and be truthful and be uh, have an honest discussion and dialogue with yourself when you're looking through all this. I understand that most of us might not have a very clear idea on calculating our investment returns. I happen to keep a record of it, um, because sometimes, a lot of times when we show just look at our brokerage statement, it might not be entirely correct based on our situation of sometimes how much we put in, how much we take out. Sometimes we need the cash, the inflow and outflow. It can distort the statement quite drastically. And we're gonna do another webinar in the future on how we can properly track our portfolio to the same degree as how a unit trust track their performance, how a professional track their performance, and we can, in that way, then we can have a measurement of truly understanding how well our, say, DIY portfolio is doing against, uh, be it either buying just a ETF or buying a unit trust, how it can truly compares. Because without that, we cannot really understand what is the best option out there for us. But after reviewing my own experience and for the last 1 or 2 decades, I come to a few conclusions. Basically, I come to a few conclusions, which is there are some things that I feel I'm pretty good at, but there are also a lot of things that I'm just lucky at. Say, for example, I realized that I'm pretty good at spotting very, very long term trends. So, if you ask me to predict what will happen in 2025, 2026, most likely I will tell you that I'll be wrong. But if we zoom it out and look at things, what could be sector that will benefit in the next 20, 30 years, so far, I feel that I do have an edge on that, and I more or less could tell them to a good degree of confidence. Uh, and I'm also pretty good at being comfortable going against the crowd. So even when market is in the panic mode in 2022, I'm still quite comfortable in investing. Um, and when market is going in a frenzy during COVID, of course, I get carried away as well. But not to a big extent to what most people might be, because I still see quite a number of people around me that could get overly carried away to the point where they start using a lot of leverage and margin and borrowing money to play in the stock market, which is something that I kind of draw a line for myself, um, to be able to invested in the stock market, stay invested, and to truly build wealth in the long term. I feel that the first thing in this game is to make sure that you survive the game, right? And to survive the game, we have to make sure that our financial position is strong, and we will not be hit when uh, any big crisis hit, or any unexpected thing happen that will make us make decision um, out of desperation, right? So there's a few things that I feel that I'm pretty good at, but I have to also admit that I'm extremely, extremely, extremely lucky to be investing, to start investing at the best period to own stocks over the last century, right? Just when I started onto the workforce, it's 2006. Of course, I got caught into the last tail tailwind of the financial bubble before '08 financial crisis. But that was also when I'm just starting out, so my capital is very, very small. And for the next 15 years, I basically tack on and ride on one of the best bull market the stock market has ever experienced in the last 100 years. And the strongest tailwind is in the technology sector, which I predominantly invest in. And that has been something that I feel it's pretty lucky on my part. Because if I have been having the same attitude as being bullish on technology uh, and wanting to invest in the stock market, but I'm just born maybe 10 years before. And when I first started investing is, say, during the dot-com era, uh, it could mean that I invest during the dot-com bubble, at the peak of the dot-com bubble, and 10 years later, my stock would still be far, far below what I started investing in. And I have gone through two major crises, the dot-com crash and the financial crisis in 2008 and 2009. And I might come out of it completely delusion about stock investing and gave up just when the biggest bull market started running. So I have to admit that um, there is a certain amount of luck that all of us live in. And I think we have to, when we take stock of our circumstances and review back on our life, we have to take a little bit of humility as well to truly understand how lucks play in part of our life. And I feel that one of the biggest danger for investor, especially if you're doing it yourself, is not understanding how lucks play in our life. And if you got too carried away and feel that whatever wealth that you have accumulated, whatever wealth that you have built, is purely because of your own capability and own skill, in the long term, I feel it could be a very, very dangerous weapon to be in, a dangerous position to be in. And one of the biggest disadvantage I see for a lot of investor is overconfidence. And once they become too overconfident, they could take excessive risk and feeling that they could never do anything wrong, and it could be the downfall for them. So something to remind ourselves and something to truly understand ourselves, what we're good at, what we're lucky at, and what makes us tick, and what are the things that we want to avoid, and things that we're not good at, what things that we don't prioritize anymore, right? So having said all that as a prerequisite, of course, I'm not gonna make a thumbnail of talking about 2025 and not tell you what I think of 2025 uh, and just create a clickbait for you. But rather, sure, I'm going to share with you some of the things that I feel uh, that the market uh, could potentially become in the future. But as a caveat here, which is I'm pretty certain that I'm going to be wrong on some of the things here that I'm going to talk about. I don't know which one yet, but I'm pretty certain I'm going to get something wrong. So that's the caveat. And just to share with you guys some of the things that I still feel would carry on true for 2025, which is number one is the US stock market. Although it has been going on a very, very big mega run, um, I still feel that it might still be the best place to invest even until today. I do admit that valuation is pretty high, and later on, I'm going to talk a little bit about signs of uh, asset bubble forming, especially in a certain area that I've been focusing on. And that's true, but we never really know when the bubble is going to pop. And the stock market is always a constant cycle of building bubble and deflating bubble and building bubble and deflating bubble. So as long as we have a very, very long-term view on it, I would say that it doesn't really matter all that much if we're truly investing for the long term, say for the next 10 years at least. Typically, market cycle go through in the cycle of 3 to 5 years. So as long as you have a time horizon longer than that, typically will still do better over time, right? So the US market is still one of the best ones that I feel would continue to do pretty well. And I'm excited for the new administration in the future on how Donald Trump is going to encourage companies to start investing in the US more and to focus on US businesses more in the future. Next is China as well. And I do feel that the China market is very, very undervalued at the moment. So I'm not truly selling out on my China stock. But uh, if if we have the idea that China could overtake US and become the world leader or world superpower, uh, I have my doubt on that. I more or less my feeling is that China could still see some growth, but they might experience something of what Japan experienced in in the 1990s. So basically, they went through very, very similar growth path. Japan also grew in the 60s and 70s very drastically and undercutting a lot of US business until to the point where US need to put tariff on Japan and control them and see them as uh, playing dirty and having a lot of price dumping to capture market in the US market. And they put a lot of tariff and they force Japanese company to invest in the US to build plants there to so that they can sell to the US market. And to the point where they more or less trigger the pop of the Japanese property market and the stock market, and they experience what we call the lost decade for Japan. I think China could experience something similar, but they could also learn from the Japanese situation, and they could come out of it faster than Japan. But for them to truly become world number one, I have my doubt that I will see it in my lifetime, right? So that's something I feel about China. But all this means that for the rest of us, especially for Southeast Asia and also to maybe Latin America as well, all these developing market outside of China could be a potential boom year for all of us, especially in the export market, where uh, the biggest consumer market, the biggest market will still be the US, and they still need products. If it's not coming from China, it's coming from somewhere else, and most likely coming from us. And China, they have all this excess capacity or all this know-how on how to produce things at scale, but they cannot export it directly from China. So they might want to start forming distribution hub or manufacturing hub outside of China and a good place with cheap labor and young workforce that is still friendly to US, more or less, is also us. So I do see good things coming our way, especially for manufacturing side, for exporting side. Having said that, investing in our side of the market sometimes is not just about whether the company will do well, but also to look into whether the management is friendly to shareholders. And if you meet a management that is that's in the business doing well, but the management might not be so friendly to shareholder or so willing to share the wealth with shareholders, uh, that potential might not trickle down to investors like ourselves over time. So that's something for us to take note of as well. But you realize something of the three key points that I talk about, which is it is not really something that is out of the ordinary. Like whatever I said, it's more or less in consensus with what the market is thinking. With if you go to other talks, these are some of the things that they will also be talking about. So if we are looking for what we call alpha, which is looking to outperform the market, that's not where we'll find it. That is the three things that we talk about is good for us to find what we call the beta of the market, which is to find places where you can invest in together with the market. But to find things that we could outperform the market, I don't think it's going to come from the three things that we talk about just now. Because to find alpha, what we need to do is to ask ourselves, what do I know that the market does not know that I know? Meaning that you have to find things that you know is true, but the market has not catch on to it. And to do it confidently and to uh, put money into and to put money into it and feel that you truly know something that the market do not know is also kind of a sign of arrogance and overconfidence. And yet, that is also something that we need to possess as investors and still be humble enough to know that there is still a possibility that I could be wrong. So there's a lot of oxymoron here of being an investor, which is you have to be confident enough to stand alone and have views that the market don't agree with you, but you almost also must have the humility to know that there are times that you can be wrong as well. So how do you protect against that is the key. So let's talk about one thing at a time. So I'm going to share something that I feel that the market has not truly grasped the potential impact on, and something that I fear and that could become a reality in the future, but it's not showing in the market yet, right? But it is also something that I know that I could be wrong. Okay. So I do feel that although I have been an advocate of ETF, and I still believe that passive investing just through ETF alone would most likely create for us a portfolio that will still outperform many of the funds out there in the market. And just tracking the the indexes could give us still a good chance of a good long-term return. But because passive investing has also grown so much in the past few decades, especially in the US. The US market, of course, the ETF market and the passive investing market is still the biggest in the US. And ETF itself is now having, I think it's something that I shared last webinar, which is the ETF market is already, I think, $17 trillion in size, which is half of the entire unit trust market in the world. So just in a short 1 or 2 decades, it has become such a force to be reckoned with. And what passive investing encourage people is to invest without thinking much, right? They advocate the idea that we should just invest dollar cost averaging, regardless the market is up or down, just buy over time. And a big part of this action is also a big view on why some of the large cap has been continuous growing in valuation over the past few years, because people are just buying into the index, and the index is mostly weighted to all the big caps. And so people are just buying the index without understanding, maybe number one, what they're buying, and also without regarding how the valuation of the stock market truly is. Okay? They're just buying on a passive uh, mode. And what this does is that we could be fueling asset bubble indirectly, because we're not caring about whether things are cheap or expensive. We're not allocating our money efficiently as a market as a whole. Because if we are just pumping our money into passive investing into all the big caps, maybe there's a lot of opportunity now in smaller cap stocks or mid cap stock. They're not inside the index, outside of the S&P 500, but we are not investing in all that because we're just buying the S&P 500 ETF, right, which is by far the largest ETF of all the ETFs. So if we are just doing that, then in terms of the entire market, we might not be allocating our capital in the most efficient way. And if that's the case, we could be inflating the bubble in this part and neglecting some part of the market that is not in the index and not in passive investing. So that could potentially lead to a big financial bubble in passive investing, which is in ETF. It could reach a point where valuation becomes so crazy that it doesn't make sense anymore. And once we have a big crash in ETF, then because a lot of investors in ETF are just doing it as passive investing and not really knowing what they're doing. So if a market truly crash, everybody might panic, and that could cascade into a huge and bigger problem in the future, right? So I'm not saying that this could happen, say into the 2025 or 2026, but it is a risk that we have to be wary of. Okay, so if we pick stock that we can only pick stock that we have an edge over the market in terms to create alpha, then there's no real need for us to just focus on growing with the market. What I mean is, if we are looking at individual stocks, if you feel that the individual stocks cannot really outperform, say, the broader index, then there's no real need for us to invest in that particular individual stocks. I'll give you an example. Like a lot of client will ask me on dividend stocks, and this might be stocks that are just not really growing in the market, but it's just giving a consistent dividend. Say a lot of times is your telco, is maybe like a toll booth operator. There's no real growth potential for them, but they're just giving out a dividend over time. And if you ask me, I tend not to invest in this kind of company, mainly because if I'm buying these individual companies, and instead of, say, buying an index fund where the index now is most of the tech companies, most of the blue chip uh, uh, technology company in the US, which is growing at still 10 to 15% at least a year. If these dividend stocks cannot really give me that kind of return, is there really a real reason that I should pick these individual stocks? Right? And if it's not, then maybe I'll just buy a dividend focused ETF, which is just a basket of them that give me a more diversified portfolio as well, and still give me the dividend that I need. Right? That's kind of how I look at picking stocks versus just buying, say, through a unit trust or through a ETF, something like a fund, uh, which will give us a much more diversified exposure. Okay, so having said all that, I just wanted to highlight again that I'm very bad at making short-term prediction, and I also feel that making next year prediction is really not that important in the grand scheme of things when you're investing for the long term, where maybe making 20-year prediction might be much more important. So something for us to uh, consider, which is although every single year we might hear, we might go to all these talks constantly. Um, every investment house or every bank talks every single year. They will talk about what to look for next year. What's the feng shui master think of next year? but but I really feel that if you are investing and building wealth for the long term, maybe all these things just treat it as entertainment, right? It's not all that important, but rather spend more time thinking about what do you think the world could become in the next 20 years and form a vision for that and invest based on that might be more fruitful for you for your portfolio as well, right? And I wanted to share a little bit story with you from the time of Warren Buffett, and this is an article he wrote for, I think, Wall Street Journals, which is the super investor of Graham and Dotesville, where after Warren Buffett was pretty successful as a fund manager, he wrote this piece talking about all the alumni, all the his colleague previously who has worked for his mentor, Ben Graham, and the people that has been the disciples of Benjamin Graham and David Dodd, which is the author of security analysis, the Bible of value investing. And in the book, he basically stated that all these people within Graham and Dodd's view, although they share the same philosophy, they're all value investors. But the way they invest and the strategy and the stocks that they own on each of them is very, very different. Some might be very diversified, owns hundreds of stocks. Some own just one or two stocks or three stocks, like Charlie Munger in particular, having a very, very concentrated portfolio. And some might invest in different industry altogether, but all of them turn out to be great investors over the long term and has great result over the long term. So what this means is building a portfolio is really more about ourselves and less about the market. So when we're building the portfolio and we're preparing a portfolio for next year, for next 2 years, for next 5 years, and next 10 years, what we need to think about is not just and less so about what the market might do in these next few years, but rather more about what kind of portfolio will allow us to give us the exposure that we need, give us the risk profile that we can take, and be comfortable and sleep soundly at night. So some of the things, I guess, just from my own experience, I wanted to share with you guys that you can take into consideration when you're building this portfolio for yourself is some of the questions to ask. Like, if you ask yourself, what is the future you expect in the next 20, 30 years? Think about that for a longer period and then form your investment thesis around that and invest to what do you think if that future is what you believe to be true, who are the companies, what are the industry that will benefit in that future, right? Not to worry about the year to year vogue, be it this year is going to be Japan who's in vogue or AI is in vogue. Next year it might be oil and gas in vogue. It doesn't matter. right? But what matters is what do you feel comfortable investing in the longer term and focusing on things, start with things that you understand. I myself doesn't have a particular industry that say I'm very particular involved in, right? I don't work in a specific industry before, so I don't really have a deep insight in one particular industry. But what I know, and when I first started out, is I think from companies that I like their product and as a customer. So I started from the view of focusing on a lot of consumer stocks, which is where I get started. Why do I like this product? And do I think that this product is superior and sustainable and could grow compared to its competitor? And then after that, I move on to a lot of tech products, but also as a consumer, right? I tend to focus a lot on technology company that serve the consumer. And a lot, and many times I was using the products of Facebook a lot when I look through my screen time on my phone, the top three apps that I use is all from Facebook, which is why I started to really invest in them. I use Google Suite, Google Drive, Google Photo, and this is why I also look into Google and Apple and Microsoft and all that. And so start with that. And something when we're planning out our portfolio, also understand our financial position. Everybody's financial position is different. At which stage of your life you're at, how's your cash flow situation, how's your balance sheet situation. A good thing, something that I do with my clients is actually I go through with them on that, right? Building up their balance sheets and building up their cash flow in my system to show them what exactly is their financial position, what could happen in different scenarios, and run the different scenarios through my software to show them how confident they need to feel about their future or what action that they might need to do to protect themselves or put them in a better, stronger position before they even start investing, right? So that are some of the things to think about. And also, even before you start investing, what is the objective for this investing? Let's say for my case, right now, most of the biggest expenses that I'm gonna need is for my kids' education, and that's roughly it. Most of the investing that I do have that objective of I want to make sure that I have enough for them when they start to go to university, and they would not be financially constrained to pursue whatever that they wanted to pursue. So that's my motivation. For you, it might be different. And that's something to become your anchor and your target to have a portfolio. So having said that, investing can be scary. So even if you go through all that, we cannot be 100% sure that we will make the right decision. And we will make some wrong decision. So building a portfolio is both adhering to uh, our vision for the next 20, 30 years and our objective, but also having a part to protect ourselves in case we got it wrong, right? So investing can be scary, but I think that most of us should still invest because the only person who really don't need to invest and can afford not to invest who are people who already realize their financial goals, right? People who has more money than they ever need, they don't need to invest. They can just put all their money in the bank. And a good friend of mine works for such a family, right? He's basically working in a family office, and he works for the ultra rich. And when he shared with me, how some of them invest, to us, it feels that they are very, very inefficient. They could have a big sum of money just in cash, or they have a very, very big sum of money in legacy asset, like some of the shares that their great grandpa invest in nobody there to touch it because nobody wants to be the person that sell off that stocks or sell off that company. So they just keep it and it's not growing. To us, it might be inefficient, but to them, they can afford it. They can afford not to invest properly because they have all the money in the world. So I feel for the rest of us, we should still take the pursuit of building a portfolio very seriously and very systematically is is the way I would describe it. This is just an example. I think this is a webinar that we done last week, so I'll not go through it on the systematic way on how I create a portfolio based on ETF. On starting, just understanding allocation. Like from what I talk about, I'm more optimistic in the US market, but I still want to make sure that I have some some protection if I'm wrong. So this could be something that I plan out for my portfolio. And then from there, I can select the exposure that I want just through ETF alone. This is something that we went through on our last session. So if you miss it, do go back and check it out. And then I also share with my ETF portfolio and how uh, just investing in ETF alone, because of their low cost structure, just maybe saving 1 or 2% over a year. If you compound it over a long period, 20, 30, 40 years, it could become millions of dollars for each of us. And all that, I still anchor back to my philosophy, which worked for me. And for my clients, some of them might not believe in some of this philosophy, which is fine. And my job with them is really to walk them through and find their philosophy and find what is important to them, how they view the world, and we construct something that suits them, right? And that's the process of how to build a long-term portfolio for next year, for next 2 years, for next decade, for next 20, 30, 40 years in the future, right? Hopefully that's useful for you guys. And before we go, I always have a spin-off section, which is my spin-off section where I share with you something that's a little bit off topic. And I'm traveling this week, so I have been listening to a lot of podcasts while driving. And this is one of the most fascinating one that I came across this week, which is the episode within Diary of a CEO, which is now one of my favorite podcasts right now. And Stephen Bartlett basically interviewed this person called Vanessa Van Edwards, which is a body language expert, and it's basically how to make friends and influence people modernize, right? And she talked about different communication skill and things that all of us could work on to become better communicators and to improve our people skill. I myself has very, very poor people skill, which is why I talk in front of a computer all day instead of meeting real people. But this is something that has been very fascinating and very useful for me. So I'm sharing that with you today. So thank you all of you, all of you. If you have any question, do pop down the chat box. I can already see some questions, so I'm going to answer that very fast, very soon. And if you have other questions, I can stay around just to chat with you guys. And just to also highlight that I myself is with iFast Global Market down in the JB office in Malaysia. And we basically focus on the entire financial planning process. And I myself like to work with clients all through that, right? I focus a lot on, like I said just now, on let me just share something with this is a systematic financial planning software that I use with them. This is just a sample but focusing on drawing out their current balance sheet, their current cash flow, and their expected cash flow in the future, and draw out where are some of the critical points be it kids education or be it they want to buy a new property. We can do out all this scenario and then and focus on planning for that and how we should be investing to reach that financial goals that each of them might have. So this is something that I do for them, and through the iFast platform where we basically have access to almost all the asset class that you need to create a full and diversified portfolio, be it unit trust, be it your SRS, your PRS, your bonds, or your stock ETF, right? So if this is something that you might be interested to go through that process with me as well, you can also click the link here or just scan the QR code and go through just a quick Google form to let me know, and I'll reach out to you when my time permits to have a chat with you first and to see if we can have a full financial health check for you and hopefully also do a portfolio building process for you as well. Because everybody is different, so I might spend a little bit more time with each of my clients, and it might take some time for me to truly do a more comprehensive work that is useful for the clients and also something that a standard that I can hold myself up to as well. Before we go, as you know, I always share something, a quote relevant to our webinar. And this week I found one from Howard Marks, which is the founder of Oaktree Capital. If you do not know him, you should check him out. He writes very, very thoughtful investment memos almost every few months and talking about the markets and how he invests and what we should think about investing about. And he talked about when most people think about the future, they ignore that the future is a distribution of possibility. Right? I read that again. When most people think about the future, they ignore that the future is a distribution of possibility. So in the end of this year and starting next year, you most likely going to be invited to many talks of investing forums and investing outlook. But I would just like to take an opportunity to remind you guys that no matter how sure the speaker might be, how confident that speaker might be on the possibility that could happen in the future, do understand that the future is unpredictable and the future is just a distribution of possibility. All of us could be right, all of us could be wrong, right? And never be too certain of what's going to happen tomorrow. And with that, thank you so much. If you need to leave, thank you for your time. We went a little bit over time today, but I still thank you all for that 1 hour. But if you want to stay for a little bit longer for Q&A, I can be here with you guys. And let's start off with a question from CL. CL, this is a direct message to me, so some of you might not be able to see it, but I'll repeat the question. CL is asking, I want to ask about how much dividend I will receive for each component of an ETF. Let's say I spend 3,000 to buy ES3, which is the Straits Times Index ETF today, and I get 775 shares. Since DBS is about 24% weightage, does that mean that I'm getting 24% times 775, which is 186 shares of DBS? Not really, not really, not really. So the STI ETF basically, yes, they will just invest in all the ETF, all the shares of STI and whatever distribution that weightage that it might be on that day. And we just buy the entire fund. And the expo, in theory, we can recreate this fund by the same weightage of the STI ETF. But it doesn't really mean that when you buy 3,000, you can go to the ETF and claim back 24% and say, I want my DBS shares and give me 186 106 shares of DBS. The ETF will only do that when we cross a certain threshold. I can't remember if it's a few $100,000, a few $1 million threshold, where if you buy, say, this $1 million of STI ETF, then you can literally go to the ETF and say that I want to redeem this ETF. Give me all in shares, and then they have to prorate all the shares and give it to you into your CPF, CDP account. But for most of us, when we buy in smaller chunks, we just own it as a fund, and that's our exposure. That weightage will keep changing as the STI weightage change. And how the dividend will goes is whatever the dividends the fund get, and then we'll just get prorated based on how much we share, how much we own on the entire funds. If you go to the fact sheet of STI ETF, they will actually share with you their distribution frequency and their distribution per shares every time, and then you can work out your dividend yield from there as well. Right? Hopefully that's helpful for you guys. Okay, if you guys have no other question, all right. Thank you so much for all your time again. And I really hope that you have enjoyed and found this session useful. Sorry for the audio this time because I'm just using my laptop, and the audio, I don't know how it will turn out. I'm going to review the playback later. But once again, thank you so much. My name is Stanley. Till we meet again, invest safely, guys. See you next round.